Congratulations! You've made a decision to take control of your finances. You want to grow your wealth and guarantee yourself a comfortable future. You've chosen your platform, opened up a stocks and shares ISA, loaded up the app, and all of a sudden you realize that you don't really understand what half of this stuff even means. ETFs, equities, fractional shares, commodities, and something about a bull and a bear in the market. Why is this all so damn confusing? Well, like most things in life, it all comes down to money. Just think about it for a second. If there's something in the world that you don't understand, chances are there's a service out there that can do the work for you. And of course, you have to pay for that service. It's business 101 really. Create a problem, or in this case, create a barrier, and then charge for the solution. That's why the banks and financial experts don't want you learning about personal finance. They get to stack their dough while you and I turn our wheel in a rat race. But luckily for you, I'm going to grab my quiver and do my best Robin Hood impression by giving you all the information you need to build your wealth and to make sure that you keep hold of your hard-earned cash. By the end of this video, you'll understand the common terms, the different categories, and how normal people invest without paying anyone for help. I'm going to split this into 5 categories, which we'll break down as we go. Cash, equities, bonds or fixed income, property, and commodities. You've probably heard of these, but we're going to break them down in terms of the role they play in investing and how you can invest in them if that's the path you want to go down. Fun fact, when I was writing this video, I wanted to use Rambo here instead of Robin Hood. You know, my name's Ram, kind of like Rambo. But a jack dude with a machine gun just didn't really have that take from the rich and give to the poor kind of vibe. Anyway, cash. We all know what cash is, right? We keep it in our wallets, in our bank, maybe stuffed in our sock drawer. Nothing much to add here, right? Well, most of us actually hold too much cash. I know, sounds crazy, right? Ideally, you want to limit the amount of cash you hold to what you need on a day-to-day basis. Maybe have some tucked away for a flat tire, broken boiler, that sort of emergency. The reason why you want to limit the amount of cash you hold on a day-to-day basis is down to inflation. Basically, every year, everything you buy will gradually go up. That's inflation in a nutshell. However, we can still be smart in the way we hold our cash. Using a high-interest savings account is a good way to start. And once we have our cash in order, we can move on to our next category, equities. This is where the language can start to throw some people off, but essentially, equities is just owning a part of a business. Shares, ETFs, and index funds are all you really need to get started. Let's start with a share. And to illustrate this, I'm going to use a few props, so please bear with me. Cue my daughter's yellow Lego car. Let's pretend this car represents a company. And let's go with Amazon. We all know what Amazon is, right? So the total value of this car, or the total value of Amazon, in our pretend scenario, let's just say it's £100. So the total value of the car is £100. And a share is just a piece of the car. So if I were to break off this random yellow piece on the top, I now own a share of the car. I don't own the car itself. This car is Amazon. I just own a tiny piece. And let's just say this is £5 for argument's sake. Now, obviously, this is a super simple version in terms of value, but the analogy is exactly how it works in real life. Now, the price of a share, or in this case, the price of our Lego piece, can fluctuate day to day. And those fluctuations come down to a number of variables. In fact, some companies can be valued so high that a single share can be valued at over £100. Let's just stick with the Amazon analogy for the time being. At the time of recording this video, a single share in Amazon costs $241. However, that doesn't mean you need $241 to get started. If you were to invest, say, £10 into Amazon, which most platforms will allow you to do, you'll own a fractional share. Fractional shares will still go up and down in value just like regular shares. The only difference being is that you own a slightly smaller slice of the pie. As a new investor, it's very unlikely you're going to know the intricacies of how to evaluate a company. So we can take all the guesswork out, and that's where ETFs and index funds come into play. To help you understand how a fund works, I'm going to use these pills. Don't worry, I'm no Walter White, even though we share the same haircut. Let's pretend that these vitamins are different stocks or companies. We have magnesium, zinc, I think this one's iron. We all know that vitamins are good for us, but we don't really know which ones we need. So we can take this all-in-one multivitamin. Say hello to an index fund. Cheers. Shame it can't help me regrow my hair. Index funds are basically a ready meal in the investing world. They gather all the successful companies into one neat, tidy package that you can buy in just a few clicks. ETF stands for Exchange Traded Fund. They're almost the same as an index fund, with the main difference being in how you buy and sell them. Index funds aren't sold or traded throughout the day like a stock. You place your order with a broker, such as Vanguard, and they act upon your order, and the price of an index fund is set once a day. ETFs, on the other hand, can be bought and sold throughout the day, just like a stock. They follow the same index, they contain the same companies, it's just the way you buy them that differs. Think of an index fund like a subscription, and an ETF is more like a bespoke product that you can buy anytime you want. Equities are generally safest to use for long-term investing. It's hard to tell what companies are going to do well tomorrow or the next week, but you know that someone's going to be doing well in the next 10 years' time. That is what you're betting on when you invest in an index fund. If you wanted something a little more secure and predictable, this is where we can use bonds or fixed income. The easiest way to think of a bond is like lending money to someone. Bonds come in two main forms: corporate bonds, i.e. businesses, or government bonds, which come as gilts. You agree to lend the company or the government some money, and they agree to pay you back that money on a set date with some interest on top. Corporate bonds are seen as slightly riskier because you're lending money to a business and businesses can go bust, while government bonds are seen as safer because you're lending money to, well, the government. It's worth mentioning that bond prices can go up and down. It's just that traditionally they're a lot less volatile than equities. Bonds are usually seen as a safer form of investment, and they're typically used when you know you're going to need your money, like when you're approaching retirement, for example. That's why pension funds love bonds. Stable income and less drama. You can buy bonds from a number of places: the NS&I website, the post office, and if you're not sure which bond to choose, there's even a bond ETF, and they function just like the one we discussed earlier. Now let's move on to something we can all relate to, something we can see and touch with our two hands. Of course, I'm talking about property. I think this is something that most people understand at a surface level. In investing terms, it boils down to owning a physical space that you can rent out. And as a bonus, if the value of the property increases over time, you make money and you gain leverage. The downside is that it requires a lot of capital up front, which quite frankly, a lot of us just don't have. But what if I told you that there was another way to invest in property and you didn't need 30 grand for a deposit? This is where REITs come in, real estate investment trusts. A REIT is a company that owns or operates income-producing real estate, things like shopping centres, hotels, office blocks, even flats and houses. Think of them as similar in principle to ETFs and equities. You can invest into a single REIT and then your money gets spread across a number of different properties. A big draw to using REITs is that they pay out a massive 90% of their taxable income to shareholders, which means you get a nice healthy dividend yield. These dividends usually get paid straight into your account every 3 months. No mortgage, no landlord stress, no maintenance, but the prices aren't as stable as traditional property, and when investing in a REIT, you don't really have any control. Now this brings us to our last category to discuss, which is commodities. Commodities are the raw materials that the world needs to function. Even in 2026, they're still seen as the building blocks for our global economy. They can come in various forms: energy, such as oil and gas; metals, like gold and copper; agriculture, which is things like coffee and sugar; and livestock, such as cattle. As a general rule, commodities tend to follow the principle of supply and demand. As an example, if the world needs more copper for electronics, copper is likely to hold its value or maybe even rise. Now, this isn't investing advice, as it's obviously a little more nuanced than that. It's just understanding how commodities work in the investing landscape. Now, you can buy commodities by physically owning them, but that's far from practical. Last thing I need to worry about is how I'm going to store the 2 barrels of oil I picked up, or explain to my wife that we now have a pet cow living in the garden. A more realistic way of investing in commodities is using something called an ETC. Remember ETFs, Exchange Traded Funds? Well, an ETC is an exchange traded commodity. You can find ETCs for things like oil and wheat, but remember, buying ETCs usually come with dealing fees. So if you can, use a platform that doesn't have any. And remember that commodities can be quite volatile, so only invest once you've done your research. Now, while on the topic of commodities, I just wanted to give a quick shout out to this thing. No, not chocolate, gold. I didn't really have a gold coin lying around, so I thought this would be the next best thing. While it certainly performs like a regular commodity, gold is a great conductor and it's widely used in the tech industry. Gold is valuable because, well, it's gold. Throughout modern civilization, we've always valued gold. And in the investing world, people use gold for what they call a store of wealth. Think about it like this. If the world's going through a period where things are a bit crazy, something like, I don't know, a pandemic, the stock market's going to be quite volatile where it's hard to predict in the short term. In these uncertain times, people with wealth might put their money into gold because we know it's valuable and it beats inflation that we spoke about in the start of the video. Using gold in this way is often referred to as a hedge, which is basically not putting all your eggs in one basket. But it's worth mentioning that gold traditionally is not a growth asset. It doesn't really do anything. It doesn't generate an income. It doesn't pay a dividend. People just use it for a hedge or diversification. Okay, while we've only scratched the surface of some of these topics, that's certainly a lot of information to digest. Let's have a quick recap. 1, keep your cash in a high interest savings account and only really keep what you use day to day and maybe some stashed away for an emergency. 2, equities are best used for long-term investments and you can get all-in-one packages in the form of index funds or ETFs. 3, bonds are like lending money to someone, either a company or the government. They give you back your money on a set date and hopefully with a nice amount of interest. 4, property is owning a physical space and being paid by rent. It can be quite difficult to get into, but you can do it on a budget by owning a REIT and still get a high dividend yield. And finally, commodities, which are natural resources. You can buy them just like a share and they're heavily linked to how we function as a global economy. If this video helped you understand some of these concepts, even by 1%, then hit that like button. And also, in the comments, hit me up. Let me know what was good, what was bad, or if you need me to explain anything further. I'm off to lie down now because I think I've OD'd on multivitamins trying to film this video. I'll catch you in the next one, guys.